Making your money work for you is one of the great appeals of trading, and selling options is a common way for investors to do just that. They can write a call, put up their existing positions as collateral, and collect a premium for their trouble. There's just one catch. They need to own enough of the underlying stock first. In most cases, it takes at least 100 shares to write a call, and that can get pricey. Plus, they expose themselves to potentially unlimited risk with naked calls. That's a no fly zone for many traders. So, what can they do instead? Well, to avoid an obvious pun, option strategies give traders a lot of choices when it comes to ways they can try to profit from the performance of an underlying. An alternative strategy to selling a naked call can be to sell a call spread, also known as a bear call spread. In general, when comparing a single leg trade to a spread trade, a few things consistently stick out. The spread trade has less profit potential, but also carries less risk. The spread trade requires less capital or has a lower margin requirement. And because of that lower capital cost, the spread trade has a more favorable break-even point. Because credit spreads use margin, make sure you understand how it works. And if you're unsure, check out our videos on margin or join a masterclass. Just like the name suggests, a bear call spread is a bearish strategy consisting of two option legs. The first leg is a short call, and the second leg is a long call at a higher strike price. Both calls expire on the same day. If this all seems like a lot to consider, don't sweat it. Let's walk through an example with our option seller, Sarah. Just a reminder that this example does not include commissions or other fees. Ensure you're aware of your broker's fee schedule before trading options. Sarah has been looking at shares of ABC One Corp and thinks the stock will stay below $50 for the next 30 days. So, she could decide to sell a $50 call for $4 to try to profit from this expectation. Remember, an option typically covers 100 shares, so Sarah's maximum profit potential would be $400. Her maximum risk would be unlimited because ABC One Corp shares can theoretically rise indefinitely. Her break-even point would be $54, the strike price of $50 plus the premium of $4. And her margin requirement would typically be 30% of the total value of the shares included in the option, or $1,500. However, Sarah can choose to sell a call spread instead, to help limit the risk and lower the cost. She can sell the same $50 call for $4 and also buy a $55 call for $2. That makes her net credit $2 and her total premium received $200. And because she sold the spread, that premium received is also her maximum profit. The difference between the two strike prices is $5. This is also known as the width of the spread. Since the width of the spread is $5, Sarah's maximum risk is $500 minus the $200 premium she received for a total of $300. But what about her break-even point? Here's an easy way to figure it out. Since Sarah sold a call spread, add the net credit to the lowest strike price. So that's $50 plus $2 for a break-even point of $52 per share. The last piece is the margin requirement for the spread trade. Any guesses as to how we do it? Here's a hint. We already did. The margin requirement for selling a spread is the difference between the strike prices or the width of the spread times the multiplier, which is usually 100. So Sarah's margin requirement on the call spread is the $5 width multiplied by 100 for a total of $500. Let's compare each trade in terms of maximum profit, maximum risk, break-even point, and margin required. The single leg trade has a maximum profit of $400 versus the spread trade, which has a maximum profit of $200. The break-even point of the single leg trade is $54, but the break-even point of the spread trade is $52. Not much of a difference so far, until we consider loss potential, that is. The maximum loss for the single leg trade is unlimited, whereas the maximum loss for the spread trade is only $300. That's quite the spread. Sorry, I couldn't resist. Lastly, the margin required to sell the naked call is $1,500, but just $500 for the spread trade. One caveat here is that the maximum risk is only limited while the spread is intact. For example, if ABC One Corp shares sit between $50 and $55 at expiration, Sarah will end up short the stock upon assignment. And remember, a short position has unlimited risk potential. In general, the spread trade offers a lower profit potential but has limited risk, lower capital cost or margin requirement, and lower break even point. So, which one should Sarah choose? As always, it's a case by case basis. She'll need to consider her risk tolerance, account funding, and confidence in her expectation of the underlying stock's price movement. Then she'll have to weigh those considerations to decide which strategy makes the most sense for her. Let's recap what we learned about selling a call spread. It can also be referred to as a bear call spread. The strategy is made up of two option legs with calls. The first leg is a short call, and the other is a long call with a higher strike price. Traders want the underlying to stay below the strike price of the call they sell. Their maximum profit is the net premium they receive. Their maximum risk is limited to the spread between the strike prices minus the net credit received. Their break-even point is the strike price of the short call plus the net credit received. The margin required for each contract traded is the width of the spread times the multiplier, usually 100. All that said, Sarah now has another income-generating option strategy at her disposal, and we hope that you do too.